everyone, welcome back. Today, we're going to do a deep dive into the world of money management.
Oh, yeah.
And this one is going to be a little bit different.
Oh.
We're working with some excerpts from a training session, kind of like a hardcore money management and trading like boot camp.
Yeah.
And the language is pretty intense.
Oh, I bet.
Lots of very specific terms, Wall Street kind of lingo.
Yeah.
But we're going to break it all down and extract some really valuable strategies that you can actually use
Love it.
to manage your own investments.
That's what I really appreciate about these sources is that there's not just theoretical,
Right.
It's all about practical application.
Yeah.
Getting down to the nitty-gritty of risk calculation and position sizing and all those things that, to be honest, I think most people just kind of gloss over.
Totally. Let's jump right in with this first concept, risk management. The training brings up this guy, Dr. Elder, and his 6% rule. Okay, imagine you have, say, $10,000 and you're ready to invest. Dr. Elder's rule is basically saying, hold on a second. Don't just throw it all in at once. You shouldn't risk more than $200, that's 2% of your $10,000, on any single investment.
Yeah.
And your total risk for the entire month should be capped at 6%, or $600 in this example.
Makes sense. So you're not risking it all on one play. What else?
Yeah, and what's interesting is that Dr. Elder really stresses understanding what he calls the worst-case scenario for each investment.
Oh, so it's not just about the percentage.
Right, so even if you're only risking 2%, that could still be way too much if you haven't really thought about the absolute worst that could happen.
Oh, interesting. It's almost like a mind shift, right?
Totally.
Most of us are always focused on those potential gains, those big wins, but we don't always think about what could go wrong.
Exactly. And it's not just about, kind of plugging numbers into a formula. It's really about separating and prioritizing your risk calculation, like for each investment, not just kind of lumping everything together.
So taking a more granular, realistic approach instead of just this broad strokes view.
Totally. And then, in addition to that, Dr. Elder also recommends factoring in things like minimum liquidity, which is basically how easy it is to convert your investments into cash, and max open positions, which is how many different investments you're actually juggling at once.
There's like building a system that considers all these moving parts.
Yeah, and he even suggests get this hitting pause on trading altogether when the market goes crazy, or if your losses hit that 6% limit.
Whoa, talk about discipline. It sounds counterintuitive, but sometimes stepping back is the smartest move you can make, right?
Totally. All right, let's shift gears a little bit to our second big idea, position risk versus portfolio risk.
Okay, bring it on.
This is where the training really dives into the difference between initial risk, which is basically the risk you calculate when you first buy something, and ongoing risk, which is how that risk changes as the market does its thing.
Got it. So initial risk is kind of like your starting point based on where you set your stop loss, that point where you're like, okay, I'm out if it drops below this.
Exactly. But then, of course, the market never stands still, right?
Never. It's always moving, always changing.
Exactly. So as the price of your investment jumps around, so does your risk. And that's where ongoing risk comes in.
So it's like you're constantly adjusting your sails as the wind changes direction.
Exactly. And that leads perfectly into this idea of static versus dynamic stop-loss orders. It seems like our trainer really favors the dynamic approach, right?
Totally. And they actually recommend using the average true range, or ATR for short, to set your stop loss.
And what is that exactly?
Think of ATR like a gauge for volatility. You're basically using it so your stock loss isn't a fixed number. It's moving with the market.
Got it.
So if things are relatively calm, your stop loss is going to be tighter.
Okay.
But if the market's going wild, your stop loss is going to widen to give your investment some breathing room.
So you're not getting shaken out by every little bump in the road.
Exactly.
That's so smart.
Yeah. And then they also talk about scaling in and scaling out of positions.
Which sounds a bit like fine-tuning your investment as you go, right?
Exactly. It's not just about jumping all in or all out at once.
Right.
You're adjusting your position size based on that ongoing risk we talked about. It gives you more flexibility, more control.
Got it. Now, we can't forget about portfolio risk.
Right, the big picture.
The big picture. The total risk from all of your investments combined.
And the trainer actually gives a pretty specific recommendation here.
Oh, yeah.
They say to try and keep your portfolio risk somewhere between 15% and 25% of your total equity.
Okay, so if you have $100,000 invested in total, your total risk from all your positions should ideally be somewhere between $15,000 and $25,000.
Exactly. A nice practical benchmark.
Yeah, that's a great way to think about it. Now, I'm curious about how all of this applies when you're trying to, like, learn from other investors.
Ooh, good question. Well, here's a little trick. You can often figure out someone's risk management style just by looking at their portfolio risk.
Really?
Think of it like a detective game.
Okay.
If someone has really high portfolio risk, they might be a bit of a daredevil.
Yeah. Yeah.
But if someone has really low portfolio risk, they're probably more cautious, more risk averse.
Okay, so you can kind of reverse engineer their approach.
Exactly. It's a sneaky way to analyze and learn from other people's investing styles.
I love that. Okay, let's move on to our third big concept for this part of the deep dive, which is Dr. Van Tharp's perspective on equity.
Okay, this is where things get really interesting.
Okay.
Dr. Van Tharp makes a distinction between total equity, which is basically everything you've got in the game, and what he calls security,
Okay.
which is basically your total equity minus the risk that's associated with all your open positions.
So it's like saying, okay, I have all this money invested, but I also need to account for what I could potentially lose.
Exactly. It's about looking at your available capital with a more realistic lens.
I love that. And then he asks this really thought-provoking question. Are you more concerned with the overall value of your portfolio or the cash you actually have?
Which one would you say you focus on more?
I honestly don't know. That's a tough one.
That's the point. It forces you to really confront your own risk tolerance and how you think about money.
Right, because someone might feel more comfortable with a $100,000 portfolio, even if $80,000 of that is tied up in investments, while someone else might only feel secure if they have, $50,000 in cash and $50,000 invested.
It gets to the heart of what he calls subjective security.
What's that?
It's the idea that different investors might perceive the same amount of capital in totally different ways.
So it's all about how comfortable you are with a certain level of risk,
Exactly.
even if someone else with the same amount of money feels completely differently?
And that's why Dr. Van Tharp really emphasizes building an equity model that fits your personality and your risk tolerance.
Okay.
Even if that means doing something different from what everyone else is doing, it's about finding an approach that feels right for you.
This is starting to make so much sense.
Yeah.
But how do we actually put this into practice? How do we make it real?
That's a great question. And it leads us perfectly to concept number 4, which is all about Dr. Van Tharp's position sizing models.
Okay, hit me with it.
Basically, he lays out 2 main approaches to position sizing. One is fixed percentage of your equity, and the other is fixed percentage of your risk.
Okay, break that down for me.
All right, so let's say you decide to always invest 2% of your total equity into each new position.
Okay.
That's fixed percentage of equity.
So if your total equity is $100,000, you're going to invest $2,000 into each new position.
Exactly. Super simple, right?
Yeah, that's pretty straightforward. What about the other one?
Okay, the fixed percentage of risk approach is a bit more dynamic. Here, your position size is going to depend on how much you're willing to lose on that specific trade.
Okay, so let's say I'm only willing to risk 2% of my equity, and I've set my stop loss 5% below my entry price. So I would need to adjust my position size so that if my stop loss gets hit, my overall loss is only 2% of my total equity.
Exactly. It's all about fine-tuning your risk exposure on each individual trade.
I'm starting to see how this all fits together.
Yeah. And then the trainer also mentions a couple other methods like fixed share sizing, where you always buy the same number of shares no matter the price.
Okay.
And then fixed value sizing, where you always invest, say, a fixed dollar amount into each trade.
Got it. So if I always buy 1,000 shares, that's fixed share. But if I always invest $10,000, that's fixed value.
You got it. There's
Oh,
so many
cool.
different ways to approach this.
It's like a giant toolbox,
And that's why the trainer emphasizes the importance of considering your max open position limit.
which is...
It's basically the maximum number of investments you're comfortable holding at any given time.
Oh, okay.
So that limit plays a big role in how you size your positions, especially if you're using that fixed percentage of equity model.
So if I decide I only want to have 5 positions open at a time, that's going to influence how much I put into each one.
Exactly. It's like a strategic puzzle.
This is really cool.
And of course, just like with any puzzle, you need to make sure all the pieces fit properly. The trainer really stresses the importance of double-checking your calculations, especially when you're dealing with significant sums of money.
It's so easy to get lost in spreadsheets and complex formulas, but at the end of the day, you need to make sure those numbers make sense.
They even warn against blindly trusting those complex Excel models.
Oh, really? Why is that?
They say it's like driving a car without understanding how the engine works.
Oh, I see.
You might be fine for a while, but eventually things could go very wrong.
You need to understand the logic behind what you're doing.
Exactly.
This has been an incredible breakdown of all the different layers of money management.
That's much to think about, right?
So much. But how do we bring it all together? That's the big question. And that leads us to concept number 5, which is all about integrating all of these layers into one rock-solid strategy.
Okay, so the training basically breaks money management down to 3 key layers: risk assessment, equity model, and position sizing model.
Okay, and those are?
Think of them as the foundation, the framework, and the finishing touches of your investment strategy.
I like that. Okay, so you start by assessing your risk tolerance, figuring out your worst case scenario. That tells you how much risk you're comfortable taking on each individual trade and for your entire portfolio.
Right. Then you choose an equity model that matches your risk tolerance, how comfortable you feel psychologically with different levels of risk. That model defines how much capital you actually have to play with. And then finally, you pick a position sizing model that works in sync with your equity model. That helps you figure out how to spread your capital across different investments while staying within your risk limits.
So it's about creating a system that works for you and your individual circumstances.
It's like building a custom-designed suit, tailored to your exact measurements and style.
I love that analogy.
And that's where things like in-sample data and back testing come into play.
Okay, tell me more about that. I'm sure our listeners are dying to know.
Absolutely. Back testing is essentially like taking your strategy for a test drive using historical data.
Oh, interesting.
So you're seeing how it would have performed in the past. This helps you understand those potential profits and risks so you can set realistic expectations for the future.
So like running a simulation of your trading strategy using past data to see how it would have held up in different market conditions.
You got it. It's like a time machine for your investments.
That's so cool.
The trainer actually gives a really practical tip here. Let's say your goal is to make 20% per year with your investing.
Okay.
They recommend that in your backtesting, you aim for a higher return, like 25% or even 30%.
Why is that? Why aim higher in a simulation?
Because remember, backtesting is using perfect data.
Right.
In the real world, things are messy.
Yeah.
You've got things like slippage, commissions, and of course your own emotions, which can all eat into your returns.
So you're building in a buffer to account for the real world messiness.
Exactly. Now, the trainer also has some strong opinions about what to do if your strategy doesn't do well during backtesting.
Uh-oh. What do they say? Is it back to the drawing board?
Absolutely. They say don't even think about moving forward with a strategy that doesn't live up to your expectations in backtesting.
Oh, wow.
It's better to revise and refine your approach now than to risk significant losses in the real world by implementing a flawed strategy.
That's great advice. So much to think about. And this next part is really fascinating. The trainer actually shares a personal story about how they figured out how much capital they would need to be financially free.
Yeah, it's a really great example of how to apply these money management concepts to your own life.
Okay.
They basically works backward from their target annual expenses.
Okay.
And they figured out how much capital they would need to generate those expenses passively through their investments.
Wow.
And it allowed them to set a really clear, concrete financial goal.
It's like taking all these theories and models and turning them into something tangible.
Exactly. And it shows you that financial freedom might be closer than you think, especially if you have a solid money management strategy in place.
I love that. Now, before we move on, I think it's helpful to zoom out for a second and revisit some of the key takeaways from our sources.
Yeah, good idea. The language is a little dense, so it's
Yeah.
always good to double check that we're all on the same page.
Totally. So what really stood out to you in those training excerpts?
Honestly, for me, it was this constant emphasis on understanding the market conditions.
Oh, yeah.
The trainer kept saying, you need to adjust your approach based on whether the market is trending up, down, or just kind of moving sideways.
Right.
They even suggested pausing trading altogether if the market's not cooperating with your strategy.
It's like the market is another player in the game.
Exactly. And it's not just about tweaking your strategy, but also about adapting your risk management.
Oh, how so?
Well, they talked about how your risk calculations might need to change based on how volatile the market is.
Okay.
They even talked about using different stop-loss strategies like that average true range, or ATR we talked about earlier, which adjusts your stop-loss based on how much the market has been swinging up and down lately.
So you're not overreacting to every little blip.
Exactly. And they really hammered home the point of not getting stuck in one way of doing things. They said if your backtesting shows your strategy is underperforming, don't be afraid to go back and rethink your market analysis or your risk management approach.
It's all about being flexible, constantly evaluating and adjusting.
Successful money management is not a set it and forget it kind of thing. It's an ongoing process.
Love it. What else stood out to you?
Another big one for me was that whole thing about not blindly trusting those fancy, complex models, especially those built in Excel.
Yeah, they had that story about almost making a costly mistake because they hadn't properly limited their position size, even though their Excel model was telling them everything was fine.
It's a great reminder that technology can be an amazing tool,
Right.
but it's not a replacement for critical thinking.
It's like that old saying, garbage in, garbage out.
Exactly. Even the fanciest model is only as good as the assumptions you put into it.
Now, before we wrap up, I want to circle back to this concept of security that we talked about earlier.
Yeah, that one's a real mind bender.
I know. The trainer, drawing on Dr. Van Tharp's work, was explaining how security isn't just about the cash you have in your account. It's about your total equity, minus the potential risk from your open positions.
And remember that fascinating idea of subjective security.
Yes. How two investors with the same amount of capital might feel totally different levels of security based on their risk tolerance.
Exactly. And it all ties back to this idea that you need to align your money management strategy with your personality and risk tolerance. There's no one-size-fits-all approach.
Okay, so let's bring this home for our listeners.
Yeah.
What are some actionable steps they can take to, level up their money management game?
Well, first and foremost, I think everyone needs to really take some time to reflect on their risk tolerance. Really think about how much they're truly comfortable losing on a single trade and across their entire portfolio as a whole.
Don't just pick a random percentage.
No. Factor in your financial goals, your time horizon, and how much you can actually handle emotionally if things go wrong.
It's about self-awareness, right?
Totally. And once you have a solid understanding of your own risk tolerance, then you can start to explore all these different equity models and position sizing strategies.
Experiment and see what works.
Exactly. And don't forget about back testing. Don't just dive headfirst into a new strategy without testing it out first, using historical data.
It's like doing a practice run before the big game.
Exactly. Backtesting can help you get a handle on the potential risks and rewards of your strategy and can save you from making those costly mistakes in the real world. And finally, I would just say, don't be afraid to break the mold. If a particular model or approach doesn't feel right to you, even if everyone else is doing it, trust your gut and explore other options.
I love that.
Money management is a very personal thing, and finding a strategy that truly clicks with your values and your goals is crucial.
It's all about taking ownership of your financial journey.
Exactly.
And that is a fantastic way to wrap up part 1 of this deep dive.
We covered so much ground.
So much. Money management really boils down to self-awareness, discipline, and being willing to learn and adapt as you go. Join us in part 2, where we'll continue unpacking these incredibly valuable insights. Welcome back to our deep dive into money management. Are you ready for round 2?
Oh, yeah. I'm fired up. There's so much more to unpack here.
One thing that keeps popping up in these training materials is this idea that, managing money effectively isn't just about picking the right investments.
It's way more than that, right?
Right. It's about, having a solid plan, understanding how much risk you're comfortable with, and being flexible enough to adjust your approach when things change.
It's like building a house. You need a strong foundation, a well-thought-out blueprint, and you gotta be ready to make changes along the way.
You can't just start throwing bricks together and hope for the best. I love that analogy. So let's revisit Dr. Van Tharp's concept of security. I think this one really got our listeners thinking.
It's such a powerful idea. It's not just about the cash you have sitting in your account. It's about your total equity. But then you got to subtract the potential risk from all your open positions.
Okay, so if you have a portfolio worth $1 million, but half of that is tied up in investments that could potentially lose value, your security is actually much lower.
Exactly. It's about looking at your capital in a more realistic way. What's truly available to you, considering the risks you're taking on.
And then he introduces this concept of subjective security, which I found fascinating.
Oh, yeah. It's the idea that two investors, even with the exact same amount of capital, might feel completely different levels of security.
Because of their individual risk tolerance.
Right. Let's say you and I both have $100,000 to invest. You might be a bit more cautious and only feel truly secure if you have, say, $50,000 in cash and $50,000 invested.
Cut.
But I might be totally comfortable with only $10,000 in cash and $90,000 invested.
It all depends on how you perceive risk and how much you're willing to stomach, right?
Exactly. We all have different comfort levels.
Yeah.
And speaking of comfort levels, let's talk about those complex Excel models again. The trainer had that story about almost making a big mistake because they relied too heavily on a spreadsheet.
Yeah, without actually double-checking the numbers.
It's so easy to get caught up in the bells and whistles of a fancy model, especially if you don't fully understand the math behind it.
It's like following a GPS blindly without ever looking at a map.
Right. You might end up at your destination, but you'll have no idea how you got there. And you definitely won't know how to get anywhere else.
So the trainer really stressed the importance of understanding the logic behind any model you're using, right?
Exactly. You need to be able to spot potential errors, tweak the inputs, and make sure the results actually align with your overall strategy. It's about taking ownership of your decisions, not just blindly following a formula.
So how can our listeners actually apply these ideas to their own investing journey? What are some concrete steps they can take?
Well, first things first, I think it's crucial to really get to know yourself as an investor. What are your financial goals? What's your time horizon? And, of course, how comfortable are you with the ups and downs of the market?
It's about introspection, taking the time to understand your values, your motivations. Why are you investing in the first place?
Exactly. Once you have a clearer sense of who you are as an investor, you can start exploring different money management strategies and seeing what resonates with you. Remember, there's no one-size-fits-all solution. It's about finding what works best for you.
And what about backtesting? I think that's such a valuable tool for investors.
Oh, absolutely. Backtesting is like a dress rehearsal for your investments. You're testing your strategy using historical data to see how it would have performed in different market conditions.
You're learning from the past to avoid potential pitfalls in the future.
Exactly. It can really help you build confidence in your strategy and avoid those nasty surprises. Now, we've talked a lot about the numbers, the models, the strategies, but we can't forget about the psychological side of investing. Our emotions can play a huge role in our decisions.
Yeah, things like fear, greed, those can really mess with your head, even if you have a solid plan. How can our listeners become more aware of their investing psychology and, avoid letting their emotions sabotage their goals?
I think the first step is simply acknowledging that emotions are a part of the game. We're human. We're going to feel excited when things are going well, and we're going to feel scared when the market takes a dip.
Right. It's normal to feel those things.
Exactly. The key is to be aware of those emotions and not let them completely control your decisions. It's about recognizing when your emotions are starting to cloud your judgment and taking a step back to assess the situation more rationally.
Having a plan in place before you even start investing can really help, right? Like defining your risk tolerance, setting clear goals, and deciding how you'll react in different market scenarios.
Totally. It's like having a set of guidelines to help you stay grounded when things get turbulent.
Right.
It prevents those knee-jerk reactions that you might regret later.
It's like a financial safety net for your emotions.
Exactly. And I think surrounding yourself with a supportive community can also be incredibly helpful.
Oh, yeah, like a group of other investors who understand the challenges and can offer encouragement.
Exactly. It's like having a team of cheerleaders and coaches to support you through the ups and downs. And remember, investing is a marathon, not a sprint. There will be good times and bad times.
It's a journey, not a destination.
Right. But if you stick to your plan, stay disciplined, and continue to learn and adapt, you'll be well on your way to achieving your financial goals.
So I encourage our listeners to really explore not just the numbers and the strategies, but also their relationship with money.
How do you feel about money? How do your emotions influence your decisions?
It's about finding that balance between the analytical and the emotional, the head and the heart.
To create a more holistic approach to managing your money. All right, let's take a deep breath here. We've covered a lot of ground in this deep dive.
I know, it's been an intense ride. But when we come back in part 3, we'll tie everything together and leave you with some final, thought-provoking insights. It'll hopefully inspire you to take control of your financial future. All right, welcome back. We're in the home stretch now, the final part of our deep dive into money management.
I can't believe how much we've covered.
It's been pretty intense, right?
It really has. But it feels like we've been given this insider's view into how successful investors think.
Totally. We've talked about everything from building a risk management framework to understanding your own investing psychology. But before we wrap up, I want to leave our listeners with one final thought to chew on.
Ooh, I like it. Hit me with it.
So we've spent a lot of time focusing on the quantitative side of money management. All the numbers, the models, the spreadsheets. But what about the qualitative aspects? The things that can't be measured, you know?
Oh, yeah, that's such a good point. We've talked about the psychology, sure, but there's so much more to it. Like, what about intuition or creativity or even just your values?
Exactly. It's like, I don't know, the difference between just following a recipe and really understanding the art of cooking.
Oh, I like that.
You can follow all the steps perfectly, but if you don't have that, like, spark of creativity or intuition, you're probably not going to create a masterpiece.
It's the same with investing. You can have the most sophisticated model in the world, but if it doesn't align with your intuition or your values, it's not going to feel right, you know? You might end up making decisions that you ultimately regret.
So, like, how can our listeners actually tap into that qualitative side of money management? How do you start listening to your, like, inner financial compass?
I think it starts with, like, asking yourself some really deep questions.
Like what?
Like, what are your core values when it comes to money? What kind of impact do you want your investments to have on the world? What truly brings you joy?
Wow. Those are big questions.
They are,
Yeah.
but they can be so powerful. It's like you're stepping back from the spreadsheets and the numbers and really connecting with, like, the heart of why you're investing in the first place.
I love that. So, like, if you start to really think about those things, your investment decisions might naturally start to change.
Exactly. You might start to prioritize investments that align with your values, even if they don't necessarily have the highest potential return. You might feel more drawn to companies that are, making a positive impact on the world.
It's about aligning your money with your purpose.
Exactly. And as you do that, you might find that investing becomes more than just a way to grow your wealth. It becomes a way to, like, express who you are and what you believe in, what you want to contribute to the world.
It's like your portfolio becomes a reflection of your soul.
I love that.
Yeah.
And that's honestly what I find so beautiful and inspiring about money management. It's not just about numbers and spreadsheets. It's about using your resources to create a life that is meaningful and fulfilling, a life that's aligned with your deepest values.
That's a beautiful way to put it. So, to our listeners, I really encourage you to take some time to reflect on those questions, explore that qualitative side of money management, figure out how you can use your investments to create a life that truly feels aligned with your heart and soul.
It's about finding that balance between, the analytical and the emotional, the head and the heart, to create a truly holistic approach to managing your money.
And on that note, we're going to wrap up this incredible deep dive. Thank you all so much for joining us on this journey into the world of money management.
It's been a pleasure.
Remember, it's a journey, not a destination. So keep learning, keep growing, and keep investing in yourself and your dreams,